Okay, so let's jump into this deep dive. Today's topic is something that hits everyone, right where it hurts: inflation.
Yep, we're talking money. Specifically, what happens when it, well, loses its value. And for this, we've got a great starting point, that Gloom, Boom, and Doom report that just came out. But we'll also be looking at a lot of other data, like historical price trends, and some pretty interesting news stories that are popping up right now.
Exactly. And our goal today is to really get to the core arguments about inflation, like what really causes it, what it does to the economy, how that ripples out to all of us, and where it might be headed next. That's the big question, isn't it?
It is, and it's something that affects every single one of us. So as we dig into these sources, the key question, the one you should keep in mind, is what can you take away from all this information about inflation? What does it tell you about the economic world we're living in right now and how that could impact your financial future? We want to make sure you're equipped to make smart decisions based on what we find.
Absolutely. So it's not just theory. We're going to be connecting historical economic thinking with how prices have actually changed over time and even some of the things that are making headlines right now. So to really get a grasp on all this, let's start by going back in time a bit. Take a look at some historical perspectives on inflation, because this isn't a new concern, is it?
Not at all. It's actually fascinating to see how far back these ideas go. For instance, in the 14th century, you had a guy, Nicole Oresme. He was basically saying that rulers who were messing with the coinage were often doing it, to line their own pockets. He even suggested that maybe the community should have some control over the money supply, and any profits that came from changing it should go back to them.
Really? That's back in the 1300s. It makes you think about who controls the money today, doesn't it? And their motivations.
It really does.
Mhm.
So even way back then, people understood that messing with money could be driven by, well, let's say self-interest.
Right, right. So then we fast forward a bit to Copernicus in the 1500s, and he's listing inflation right alongside things like wars and epidemics as a major cause of societal decline. What really struck me was his observation that while wars and diseases are really obvious and hit hard and fast, inflation is much more subtle and gradual. It kind of undermines society from within over time.
That's a great point. Copernicus recognized that it's not this immediate catastrophe, this big dramatic event that grabs the headlines, but the cumulative effect over time of inflation eroding purchasing power and destabilizing economies can be just as devastating as any war or plague. And that's why it's so insidious. It often flies under the radar until it's too late.
It's like a slow burn, isn't it?
Exactly, a slow, persistent drain that people often don't fully grasp until the consequences are widespread. And that's why it's so important to look back at this historical perspective. It shows us that the concerns we have about inflation today, these aren't new. They have deep roots.
Now, when you look at the history of the U.S. economy, there's this stark shift that's shown in Figure 1 of the Gloom, Boom, and Doom report, right? It seems like there are two distinct phases. Before around 1910, prices were pretty stable, and then after that, there's this clear, sustained upward trend. And the report points out that this shift coincides with, well, the creation of the Federal Reserve in 1913.
Yeah, if you're looking at that chart, it definitely suggests a relationship there, doesn't it? The period before the Fed, when things were very different in terms of how the money system worked, seems to have had a totally different experience with inflation compared to the era after the Fed was established. And that brings up a big question that is still debated today. What role does central banking play in all this? How much does it affect long-term price stability?
That's the million-dollar question, right? Now, shifting gears a bit, let's look at the chorus of voices in these sources that are really concerned about the negative impacts of inflation. There are a lot of them, from different time periods, different economic schools of thought, all saying similar things.
Yeah, there's this recurring theme, a warning that comes through loud and clear. Like you've got Henry Hazlitt arguing that inflation is not only unnecessary for economic growth, it's actually harmful. It disrupts production and messes with employment. And then there's Carl Otto Pohl with his really vivid analogy. He compares inflation to toothpaste. Once it's out of the tube, good luck trying to get it back in.
Right, that's a great way to put it.
And then you've got someone like Vanita Van Caspel, who points out that inflation has this sneaky way of redistributing wealth. Often it benefits the people who are in the know, who can see it coming, at the expense of those who are less informed or less prepared. It's not some neutral force. It creates winners and losers.
Exactly. And then you've got figures like James Garfield, even Ronald Reagan, talking about how inflation acts as this hidden tax and how whoever controls the money supply has a tremendous amount of power. It reminds me of that quote from Thomas Sowell, where he says, inflation is essentially a way for governments to get wealth without having to directly tax people.
It's like sleight of hand, isn't it? It makes you think about the ways governments finance themselves, the things that aren't always so obvious. And what's really striking is how consistent these warnings are across different time periods, different political viewpoints.
Yeah, it's not a left or right thing. It's just this concern that keeps coming up.
Exactly. Whether it's G. Edward Griffin suggesting that inflation lets governments fund wars without having to raise taxes explicitly, or even Charles Lindbergh's rather dramatic warning about inflation being created by powerful trusts, the underlying worry is there. It's about the potential for manipulation and the erosion of individual wealth, the threat to economic stability. All these voices together, they paint a picture of inflation as a deeply problematic force.
Okay, so let's bring this into the present day. What about the observations and trends that are happening right now? Doug Rudish has some really interesting insights on this, right?
He does. He touches on something that I think a lot of people feel, which is this disconnect between what the official inflation numbers say and what their own lived experience is telling them. Like the cost of living seems to be going up faster than those numbers suggest. He brings up the 5.2% pay raise that federal employees are getting in 2024, and he's pretty skeptical. He's basically asking, did their productivity really jump that much?
Yeah.
Or is this more a reflection of inflationary pressures that aren't being fully acknowledged in the official reports?
It makes you wonder, doesn't it? If inflation is supposedly under control, why such a big pay bump?
Exactly. It suggests that maybe there's an internal recognition that the cost of living has actually gone up more than the official numbers are saying.
Right. And then Rudish points to a real-world example that a lot of people can relate to, the price increases at Chick-fil-A.
Mm.
Apparently, they've gone up by a pretty significant 21% in just 2 years. That's not some abstract data point. That's something people notice when they're trying to grab a quick lunch.
It's tangible, right? And Rudish's point is that while a 20% increase on one item might not seem like a huge deal in isolation, when these kinds of increases become widespread, it really changes the game over time. It's the cumulative effect on your budget that really matters.
It all adds up.
It does. And Rudish doesn't shy away from calling out what he sees as, well, let's say misleading statements from officials. Like he's got this really sarcastic take on Janet Yellen's view that rising treasury yields are a sign of a strong economy. He's basically saying, oh yeah, sure, higher borrowing costs for the government, that totally means the economy is rockin'.
He's poking holes in that narrative.
He is. He's making us question whether those rising yields are truly a sign of a healthy economy or if they could also be a consequence of, large government deficits and mounting debt. It's a critical point to consider. What are these signals really telling us?
Right. What's the real story behind those numbers? Then there's this interesting example that the report uses about the world's largest EV charging station, which is supposed to illustrate a quote from Thomas Sowell. He says, much of the social history of the Western world over the past 3 decades has involved replacing what worked with what sounded good.
That's a powerful statement, isn't it? This idea that good intentions don't always translate into good outcomes. And that image of this massive EV charging station that might not be fully utilized, it's like a metaphor for these investments that were driven more by, trends or political agendas than by sound economic principles or actual practical needs.
It makes you think about efficiency versus just aspiration, doesn't it?
Absolutely.
Yeah.
What sounds good on paper doesn't always work out in the real world.
And speaking of EVs, the report then dives into what's been happening with Tesla in early 2024. After a really strong 2023, the beginning of this year brought some not-so-good news for them. A big drop in market value, Hertz scaling back their EV plans, price cuts in China, signs of slowing demand, and on top of that, BYD actually surpassed Tesla in global electric car sales.
Yeah, it's a reminder that even these high-growth sectors can be really unpredictable. The fact that Tesla, a market leader, faced these challenges shows that nobody is immune to shifts in consumer preferences, increased competition, and those broader economic headwinds. And BYD overtaking them, well, that just highlights how global and how competitive the EV market is becoming.
Okay, now let's get into what the report calls the WTF happened in 1971 theme. This is the year the U.S. ended the direct convertibility of the dollar to gold, a really pivotal moment. And there's this whole website dedicated to tracking price and wage trends since then.
Yeah, it's a treasure trove of long-term data, and the report pulls out some examples of the cost of living in 1971, and you can't help but wonder how those prices compare to today. And while it's true that the quality of a lot of goods has improved significantly since then, like cars, for instance, the Bureau of Labor Statistics tries to adjust for that in their inflation calculations. But still, there are other things to consider. Regulations have changed, and the big question is, have wages kept up? Can the average person still afford the same things?
Affordability, that's the key, isn't it? And speaking of wages, the report points out that there's a discrepancy between the average annual salary reported by the BLS for 2023 and the average reported by Forbes.
It's interesting, right? And it highlights how different data sources and different calculation methods can give you slightly different pictures when it comes to something like average wages. Different surveys might include or exclude different types of workers, different kinds of compensation. It's a good reminder that you can't always take economic data at face value. You have to understand the context.
Yeah, you have to dig a little deeper. And then there's that classic example of inflation in action, shrinkflation. The report mentions how Starbucks seems to be making their sandwiches smaller while keeping the prices the same, or even raising them. It's something I think we've all noticed at some point, maybe without even thinking of it as inflation.
It's sneaky, isn't it? This is a perfect example of how prices can effectively go up without a direct price hike. You're paying the same or more for less product. It's a subtle way for businesses to pass on those increased costs to consumers, but consumers are savvy. They often pick up on these things, even if they don't use the term shrinkflation.
Okay, moving beyond everyday purchases. The report then looks at asset price inflation, and the big takeaway here is how uneven the impact has been, especially when it comes to housing. This is something that affects so many people directly.
You're absolutely right. The increase in home prices, particularly when compared to income, is really striking. Figure 8 in the report shows how dramatically the number of years it takes to save for a home has increased from 1950 to 2020. That's a clear indicator of declining affordability. And Figure 9 just reinforces this, showing that in 2023, only a small percentage of homes for sale were actually affordable for the average person.
The dream of homeownership is getting further out of reach for a lot of people.
It is, and this isn't just a U.S. issue. It's happening in many Western countries, major business centers, Canada, Australia. It's a widespread phenomenon. Now, Canada has seen a bit of a decline in home prices recently, but it's still a major issue.
So it's global.
It is. And what's interesting is that even in a place like Amsterdam, which has data on housing prices going back to the 1600s, Figure 11 shows that affordability has been on a downward trend for a long time, even after adjusting for inflation. It's a long-term structural issue in many places.
But then you see this stark contrast when you look at commercial real estate. The report highlights that San Francisco's Westfield Mall has lost a whopping 75% of its value. And there are similar stories of office buildings in Los Angeles selling for way less than they did just a few years ago. It's a completely different picture than the housing market.
Yeah, it shows how differently those two sectors are being affected. While residential property has been booming in many areas, commercial real estate, especially office spaces, is facing these huge challenges due to things like remote work and changes in how people shop. It's a tale of two markets.
And the report makes an important point about how these different types of declines affect us. It says that a fall in commercial property prices might not have as much of a direct impact on individual spending as a drop in residential prices, although it does acknowledge that there are indirect effects through things like pension funds.
Right, because most people don't directly own large commercial properties, so the immediate impact on their personal finances might not be as obvious. But pension funds, which many people rely on for retirement, often do hold these assets. So a big decline in commercial real estate could have longer-term implications for retirement accounts, even if it's not directly hitting people's monthly budgets.
Right, it's something to keep an eye on. Now, the report then dives into the demographics of the housing market, and it points out that baby boomers own a disproportionate share of large homes, often with low or no mortgages. They've benefited greatly from wealth transfer and the fact that home values have increased much faster than incomes have. And this is in stark contrast to millennials, who are now facing these sky-high home prices and rising rents. It's a generational divide.
That analysis from Redfin is really eye-opening. It shows how different the experience has been for these two generations. Boomers, who came of age during a time of favorable economic conditions and low interest rates, are in a much stronger position when it comes to housing. Millennials are struggling to catch up. They haven't seen that same level of asset appreciation relative to their incomes. And Figure 17 really highlights the growing gap in wealth and income growth between the top earners and everyone else.
Yeah, it's a sobering chart. And it's not just about buying a home. The report also mentions that the stock market, as measured by the S&P 500, also looks quite expensive when you compare it to wages. This makes it harder for younger generations to invest and build wealth that way, too.
It's another sign of potential asset price inflation and how it can create these barriers for people who haven't already accumulated wealth. It's like the entry point is getting higher and higher.
One thing that really jumped out at me was Figure 19 in the report, which suggests that the actual price increases we've seen over the past 3 years might have been even higher than what those traditional price indices are reporting. It kind of makes you wonder if those official inflation numbers are really capturing the full picture.
It does raise some questions about how accurate those statistics really are. If the actual prices for those everyday goods and services that people buy are rising faster than what the indices are showing, it means the erosion of purchasing power could be even worse than we think.
Right, it's something to keep in mind. And looking ahead, the report points to a couple of factors that suggest inflation might stick around. One is the huge U.S. fiscal deficit, meaning the government is spending way more than it's taking in. The other is the massive amount of U.S. federal debt that's maturing in the next year, which will require a lot of refinancing. Both of those can have implications for inflation.
Those are definitely red flags. Large deficits can fuel inflation because they mean more money is being pumped into the economy. And all that debt that needs to be refinanced, well, that creates a lot of demand for borrowing, which can keep interest rates high or even lead to more money printing, both of which can push inflation up even further. It's a vicious cycle.
So to wrap things up, the report shares some final thoughts on what it calls the curse of inflating prices. It talks about the expectation that central banks might start cutting interest rates in 2024, possibly due to the U.S. Treasury's financial needs or political pressure, even if inflation isn't fully under control.
It's a tough spot for those central bankers, isn't it? They're facing these competing pressures to support economic growth and manage the costs of government debt. But easing up on monetary policy too soon could reignite inflation.
And then there's that worry, that inflation could pick up speed again because of all the factors we've discussed, plus those ongoing global conflicts. It makes me think of that toothpaste analogy again.
Yeah, Paul was right. Once inflation is out there, it can be really hard to get it back under control. People start expecting prices to keep rising, and that can become a self-fulfilling prophecy.
It's a tricky situation. The report talks about the dilemma facing the Fed chair with those high asset prices, a fragile economic environment, and the government's need to refinance all that debt. It suggests that the Fed might be leaning towards lowering rates despite the risks of inflation.
It's like walking a tightrope, you know? Lowering rates could provide some short-term relief, but it could also exacerbate those long-term inflationary problems. But raising rates too aggressively could trigger a recession. There are no easy answers.
It's a tough job.
It is. And going back to that point from Copernicus about how inflation affects things unevenly, the report highlights that increasing the money supply doesn't impact everything equally. It can lead to too much investment in some areas, not enough in others, and then you get these price adjustments as the economy tries to rebalance.
It creates distortions.
Exactly. And that's why it's so important to understand that inflation doesn't just raise all prices uniformly. It tends to benefit those who get the new money first. And that can lead to a misallocation of resources, those boom and bust cycles.
And the report uses those commodity price spikes in the 1970s as an example, showing how different types of commodities peaked at different times. It also looks at where those prices stand today, in real terms, adjusted for inflation. It gives you a sense of how inflation plays out across those different markets.
Those historical examples are really valuable. They show how cyclical markets are and how risky it can be to just chase what's been performing well recently, because different sectors react to inflation in different ways and at different times.
Which leads to the report's warning about being careful with assets that have already seen big price increases. Because markets are cyclical, and inflation can really amplify those price swings, potentially leading to bubbles that eventually burst.
Those bubbles are a classic symptom of monetary inflation. What goes up fast can come down even faster. And that's why diversification and a long-term perspective are so important for investors.
The report also mentions gold, which has actually done a decent job of keeping up with inflation since 1970. It suggests that right now gold might be fairly valued in real terms, but it could really shine if there's a deflationary debt collapse. That's an interesting perspective.
Yeah, gold has this reputation as a safe haven asset, a hedge against inflation, and the report offers a nuanced view on its potential role in different economic scenarios. It's definitely something to consider for those looking at long-term investment strategies.
To wrap things up, the report shares some brief thoughts on investing right now. It suggests that U.S. stocks might be overvalued, especially relative to GDP and wages, which could point to a bubble. It also raises the possibility that the global economy might be slowing down, pointing to indicators like copper prices. The overall message is one of caution, given those high global debt levels and all the geopolitical uncertainty.
It's a reminder that we're living in some pretty uncertain times, And while there might be some opportunities out there, the report emphasizes the need for prudence, diversification, and a long-term view. That, coupled with those warnings about potential asset bubbles and the link between economic and political forces, it's a sobering but necessary message for anyone navigating the investment world right now.
So to bring it all together, all these sources we've looked at today paint a picture of these ongoing inflationary pressures that are affecting different things in very different ways. And this unevenness creates a lot of uncertainty and risk when we think about affordability, wealth inequality, and the potential for bigger economic problems down the road.
It's a complex picture for sure, and looking back at history reminds us that these aren't new challenges. And what we're seeing now highlights that tension between what the official narrative is and what people are actually experiencing in their own lives.
Exactly. So here's something for everyone to think about. How do these insights into inflation, its causes, and its consequences, how does all this affect your understanding of your own financial situation? What are some of those under the radar indicators that you should be paying attention to in the months and years ahead? It's a lot to digest, but hopefully this deep dive is giving you some food for thought. Thanks for joining us.